Hello, my name is Steve Bigelow with the Candlestick Forum. Today's trading was pretty well predictable in the sense that when we combine our analysis of the direction of the market and where it's trading in relation to the T-line, even though we had a strong up day yesterday, notice that it failed at the T-line. Notice today they opened at the T-line, traded up a little bit, but failed at the T-line. Very simple T-line rule. You're in a downtrend based upon a candlestick sell signal and a close below the T-line until you see a candlestick buy signal and a close above the T-line. The alert, again, was stochastics were not in the oversold area, and they had a hard time holding up at the T-line. Where's the next logical target? Still down here at the 50-day moving average. That same scenario could be applied to the trend of the NASDAQ. After we saw the gap up doji in the overbought area, gap down, close below the T-line, we had an inverted hammer once the NASDAQ hit the T-line, bounced up, but look what the bounce took you, right to the T-line. And when it started selling off, came right back to the 50. This was just still adding the credibility of the fact that as long as we're below the T-line, we're in a downtrend. Very simple T-line rule. And it was enhanced by the fact, again, that the stochastics were still heading down, not in the oversold area yet. So there's some benefits to candlestick patterns, and one being, as long as your patterns like the fry pan bottom and our recommendation on Tupperware, even though the market has been going excessively in the bearish direction, the patterns still work. Tupperware was up strong again today based upon this fry pan bottom. Now that's going against the trend. The dumpling top, as our recommendation in shorting Boeing, was based upon this slow curve top, and then they gapped it down from a doji. We're still below the T-line, telling you there's still a lot of force to the downside. Good time to be shorting Boeing. And this also relates to when we see sell signals. Apple did a bearish left-right combo after gapping up in the overbought condition. Gap down the next day, closed below the T-line. Inverted hammer, positive trading yesterday, but indecisive. Opened right at the T-line today and started trading down. We knew that this was not a buy yet until we could close above the T-line, because as long as your stochastics were heading down and you couldn't get above the T-line, you're probably still heading for the next viable target. So this makes common sense as whether to be going long or short. Obviously, if we can analyze that the market's heading down and we can see sell signals like long-legged dojis close below the T-line, we can be shorting with the expectation it's heading down here, which was our expectation shorting this one, that at least would hit the 50-day moving average, maybe lower. So tomorrow we have to see how they open this. If they open up positive and start trading positive, that's a good indication the 50-day moving average is going to act as support. If they open it lower, good indication the 50 is not acting as support. They're probably going back to the next support level. As long as we're trading below the T-line rule tells us you stay short or you're in a downtrend until you see the buy signal and a close above the T-line. You can pick logical targets based upon which direction your stochastics are heading. That'll be it. We'll see you in the chat rooms.